Okay, first, quick disclaimer. I'm not a financial advisor. We're not a broker. Old School Valley is not a broker. We're a software investment company. So please make sure you do your own research. Past performance is no indicator of future performance and all that good stuff. All the examples that I show you today, it's going to be based on today's date. So for somebody who may see it a couple of days later or a week later or something, please, it is not an investment recommendation. Okay, so first off, there's a lot of people interested in knowing how to value stocks. So if you want to value stocks from a business perspective, you're also busy and you want to take better control of your portfolio. And at the same time, you want to be able to know when to use and not use a DCF, or when it works and when it doesn't. Plus, if you really want to eliminate the hassle, get your head out of the sand with all the details and just really get a business valuation and investing perspective of how to run a DCF, then this is going to be for you. On the flip side, if you're looking for a corporate finance DCF training, somebody asked me a question, or it's up in the question that they want to see how to value financial institutions and everything. Okay, I won't be going into every single detail. There's just not enough time for that. DCF, it's a whole semester course if you need to go into all that good stuff. Okay, if you also have a job or an exam coming up, we're not going to be teaching you the stuff that you may be looking for. And again, valuation is not the be-all in investments. We take a holistic approach. The whole point of this webinar is to help you understand the behind the story, get you really flowing into and understanding the whole process of how to do valuation. Okay, you don't have to spend 10,000 hours to become the next Warren Buffett. We're looking at things from a big picture perspective and then going down into the details to where you make adjustments, so that hopefully if somebody asks you about a stock that you hold or something that you'll be able to explain to them quickly why it's probably worth this and this, and bring the conversation that way instead of just constantly speculating. Because this is how we all start, right? I mean, I'm in the same boat. When I was at work, one of the things that, especially like in 2006, 7, and 8, before the big crash, everybody was talking about stocks, solar stocks, renewable energy, everything, tech. And then they'll come up with all these reasons about why they need to either buy something or why I should be in something, right? And maybe you're still going through that now with what the market's doing. But what it all comes down to is these same people buy high and then sell low. I've read so many stories of people who bought at the peak, then sold at the great recession, and it took them 5-6 years before they actually broke even. And that's because there's just not enough emphasis on valuation, because it's not sexy. Plus, it's a ton of work. So this is my bookshelf. I constantly churn the books to keep the best books that I love on my shelf that I constantly go back to. And so people are not going to be spending time, especially if they're not interested in investments and stuff like that, to focus and to just consume all this information and knowledge. So over the past, it's getting close to a decade now, I've been creating spreadsheets, I've been creating tools just for investors for my own purpose, and to the point where you know about Old School Valley today. And that's why Old School Valley, we started in 2008. I'm a former test engineer. That's why I just love getting into details. I'm a stickler for the details. I just really love going deep, diving into the data. I call myself a 3-in-1 geek, value geek, data geek, optimization geek. But most importantly, I'm a private investor. I know what you're going through because I went through the same thing, and I eat my own cooking, and I eat a big portion of it. So here's what you will learn, what I hope you'll take away. We're going to go over how to value stocks like a business from a business valuation standpoint. It's going to be a real world approach. And we go over discount rates, growth rates, as well as examples. You won't learn the following. I'm not going to go through like how to model DCFs, merger and acquisition style. I'm not going to go into the whole topic of levered versus unlevered free cash flow, WACC calculations, complex formulas, et cetera, et cetera. First, I want you to understand your objective, because you have to be able to zoom out and look at what you're really wanting to do with valuation, with investing in stocks. The story or the imagery that I like to tell people is, okay, are you trying to be a mechanic? Are you trying to be a surgeon? Or do you really just need to direct and drive a car? Do you really need to know exactly every single circuit board, how all the wires are wired up in a car? Or are you happy being able to turn on and off the radio button, being able to switch channels, being able to use it, and just getting feedback for what your inputs are? A lot of the time people get mixed up with this. They think that when you get into valuation, you have to understand every single detail. To some degree, yes, you have to understand the big picture, the big driving inputs, but you don't have to understand, and you don't have to go into every single detail. Here's some myths about valuation. And I'm going to be quoting a lot from Professor Damodaran from NYU. I mean, he is the authority on valuation. You can't go wrong with him. And so I was looking at his stuff. I read and learn from his material all the time. And I thought that this slide was absolutely awesome. So I just copied and pasted it. Professor, if you're watching one day, I apologize, but I'm giving you credit. But the important thing is that all valuations are biased. Okay, there is no such thing as an objective value. Yes, we use an objective approach, but the actual number is not objective. Everything is biased. It has your assumptions, and there's no precise number. If somebody says, okay, my stock is going to be worth 56.22 in 3 months, you can call him a liar. There's no way a stock can be valued like that, because it's a range of values based on what you perceive the value of the company to be and the direction of the company, right? And just because a valuation is complex, it doesn't mean it's better. Yeah, there are some instances where it could be, but like all things, keep it simple. Some of the best things don't have to be super complicated. So valuation is more art than science. If you look at this picture, what do you see? Okay, you're either going to see a vase or you're going to see two faces. And you're looking at the same picture as I am, but you're going to be seeing different things. We look at the same facts and we look at different things. And that's exactly what you're going to come across. When Warren Buffett, when he talks about DCF, he says that, or the value of a business, he says that it's the discounted value of a cash that can be taken out of a business, specifically noting and mentioning that the DCF method is how you actually value a business. So why would you use a DCF and why wouldn't you? But for the DCF, a pro is that, it's a very good, close, approximate to intrinsic value. And if your inputs are good, if you understand the company, if it's solid and sound, then it's a really good driver. It's not going to be influenced by whatever's happening in the market. And the myth about, another myth with DCF is that, if it's if the company is like losing so much money, it's negative, you can't really do a DCF. Well, the truth is you can't do an easy DCF. You can do a complicated one, but it is possible. So you can actually do a DCF for every scenario. It all just depends on what you determine the scenario to be. So the con is obviously based on the input. It's going to fluctuate. It's going to go up and down. It's very volatile. The inputs are very volatile, especially if you use something like free cash flow for a young company. You have no idea of what the stable rate is going to be. It's going to be difficult. Another thing is, if you're trying to do a really complicated DCF, especially by hand, you're going to spend a lot of time. It's very time consuming. So getting back to the whole range, now this is a screenshot from not the DCF that I'm going to be going over, but just to give you an visual idea of, you have to come up with a narrative for a conservative, a regular scenario, and an aggressive scenario. Instead of just anchoring on a specific point in time scenario like the current or what it did last year, one of the pitfalls that we fall into is we look at a specific data or a specific filing, and then we just either extrapolate or we don't think about the broad range of scenarios. But if you constantly get into the practice of trying to come up with a conservative base as well as an aggressive base, you're going to trigger yourself mentally saying, okay, here's what could potentially go wrong, and here's what could potentially go right. And then it gives you a big picture overview so that you don't just limit your focus and get tunnel vision on just calculating numbers and trying to come up with a single value. So I love this image because it shows Professor Damodaran and how he's been valuing Apple for a long time. And each quarter, he goes through the valuations or when he has time, and then he updates it. You can see that valuation is not a standstill. There is no single flat horizontal line saying, okay, I value Apple at $80 and it's going to be at $80 until I see a certain something. No, he goes through and constantly updates his adjustments and assumptions based on what the company has done. So there's obviously always going to be some backward-looking information and inputs, and you can't get around that. But it's a really good representation of showing, okay, if you can do valuation. In 2010, we had no idea that Apple would be where it is now with their product line and all that stuff. But because you're pricing in the base case and the low and the aggressive case, you get a range of margin of safety, and then you can actually this provides a good way of following through that valuation, just really understanding the whole concept. Warren Buffett again, he talked fairly a lot about valuation, and again he's saying that it's an estimate rather than a precise figure. And the assumptions and inputs that you need, you have to have a narrative of the future. Okay, whether the company is going to go down, whether you think it's just going to flatline, or whether you think it's going to go up. There's always going to be 3 types of main scenarios, and you have to account for that. The most difficult part in the DCF is going to be choosing the cash flow data. There's different methods, and this is where you have to put in a lot of thought into determining the company. This is why you have to have the narrative of the future. Okay, is the company going to go from negative to positive and then just really rocket its free cash flow growth, or are they going to be continually reinvesting the cash and driving growth on earnings? So you have to think about, okay, what is the best input for that? Growth rates, I'll talk about that. Discount rate is another important thing that we'll go over. A lot of people ask about that. Margin of safety is obvious. I won't spend too much time on that. So again, DCF, it's the value of an asset over the expected cash flow of its lifetime. Okay, it's the time value of money. So let's dive into choosing a cash flow. So a lot of people have mentioned, including Seth Klarman, when he talks about cash flows, he specifically tells you upfront, he's straight up, that it's not easy. When you try to do a net present value analysis, it's one of the most difficult things you can do because it's very uncertain, it's very unpredictable, very volatile. So what are you going to do? So I made this simple guide. Now, this is just a very rough rule of thumb. Based on the hundreds of valuations and just stocks that I've looked at. And because I use old school value and you've been using spreadsheets and stuff, I don't spend a lot of time entering the data. So I can just get all this stuff automatically. And just based on what I've seen and recognized is that if you come across a slow growing company, it's very the first one is highly representative of Walmart. It's a very low margin business, extremely competitive in retail, and it grows pretty slowly. So if this is the case, because there's some stability at least, you can. It's good to use free cash flow. With Walmart, I would definitely use free cash flow. If it was something else like super value, where the free cash flow isn't as good and it's just much more volatile, then I'd stick with an earnings-based method so that it smooths out the data. When you get to the solid company, anything that has a solid track record, Apple nowadays is considered a solid company, despite their growth, despite how much cash they're making, and just the market advantage they have. I still choose free cash flow or owner earnings for these really solid companies. When it comes to growth, Amazon in its early days, it would have been really difficult to get the cash flows. Just the other day, I was actually reading Professor Damodaran's blog post on Amazon, and he was going over his past assumptions 10 years ago as opposed to what is now. And you need to see what a big difference it is when it comes to assumptions. So for these growth companies, instead of trying to get project cash flows, I go with earnings growth, because I don't want to mess around with assuming it's going to go from negative $100 million in free cash flow to all of a sudden like 1 billion 5 years down the road. Same thing with volatile companies and capex heavy companies, oil, drillers, miners. These companies are very difficult to base on a pure free cash flow basis, because the whole business is driven by constantly using money. So that's why I would choose earnings based. So here, use this as a rule of thumb. It's not, it's use it as a starting place. Okay, so don't say that. I'm not saying that this is going to be exactly it. In this example of Sirius XM, I'm using free cash flow, and the starting value is going to be based on $1.5 billion. And I just adjusted some growth rates to show you the example of discount rates. And based on this, if you use this example, let's go to SIRI, I'll go to DCF. Okay, so I'm going to use free cash flow, 1.5, 10%, just to show you the different effects. I'm going to keep the other things constant. Sirius XM. EPS, if I used EPS with the starting value of 745 million, then the fair value is going to be $2 with, let's just saying, everything else being equal. If I were to change this to free cash flow, you'll see that the fair value jumps from $2 to 474. Okay, it's actually different because the discount rate, oh yeah, free cash flow. And then if I change this again to owner earnings, it changes slightly, goes down to 427 because of this. Now, when I look at this, one of the ways I choose it is in the DCF valuation, I look at the data. I look at free cash flow, I look at owner earnings, and then I look at the net income. Just because the stock prices, there's all these studies that show that stock prices track earnings better than it does free cash flow. So just to get a ballpark figure estimate, this is what I use. When I look at all three and compare the historicals over the past 10 years, I see that free cash flow has actually been doing much better, because before the actual merger, when they merged between Sirius and XM, you can see that they're losing money. And then even after the Great Recession, very first year, 2009, they posted a pretty big free cash flow improvement. That's huge. And then it's been consistently just been rocketing up since then. And this isn't what a lot of many companies can actually do. On the flip side, you compare that to net income earnings, and then you see that there's all these big losses, and then still losses, slight increase, then a big jump, a huge jump, which I view as an anomaly, because then the following years are so much lower. So when I look at this, I'm not going to, my initial recognition is going to say, okay, Sirius is more suited to a free cash flow, simply because it's being driven, the business model drives free cash flow. It's a media company, so they throw off a ton of cash. So my selected input would be free cash flow. So this is the input that I'm going to be using. Then if I go into the discount rates, again, remember this image as you keep doing valuation. Even with discount rates, are you trying to go like really deep into the details and understand everything and update everything? Or what type of hurdle, what type of return are you looking for? So in this spreadsheet, Sirius XM, it's classified under cable TV, and according to this weighted average cost of capital spreadsheet, the value is 7%. So you can average out earnings over 7 years. What you can do is, okay, just see, if it's a very fast growing company, you can average out. I don't do 7 years. And the reason why is because if you try to average out 7 years for a growth company, like if you go to the early years of Amazon, Tesla, or Apple, or anything, 7 years is going to smooth it to the point where it drastically undervalues the actual growth and the actual value of the company. So if it's something fast growing, then I would average out 2-3 years. If it's a solid company, then I could average out more. But for the most part, 7 years is going to be a bit too much. 10 years is overkill, unless you really know that you choose the correct company. Again, back to the discount rates, Sirius XM, cable TV, the cost of the WACC is going to be 7%. If I enter 7% into Sirius XM valuation, okay, right now it's at 9% because it's just a default hard number that I use, and I'll explain why. If I enter 7%, I get a fair value of $5.80. You can see the difference between 9% and 7%. So it goes up about $1.10, which is a pretty big margin considering the current stock price, which is about a 20% range. So the discount rate will definitely affect it. Let me switch back. But here's the business valuation side of discount rates that I prefer to use. You can use that, and there's nothing wrong with it. Just requires a little bit more time, but make sure you use the correct value and the correct industry input. But the way I do it and the way we hard coded in old school value is, instead of trying to gather so much different variables that come up with the calculation for cost of capital, what I do is I find out what the risk-free rate is, the long-term treasury bond. Okay, so if I can't get a return on investment greater than that, I shouldn't even be investing. I should just be placing my money in the risk-free rate. But since I'm in the stock market, I want to have a certain rate of return for putting my money into a risky asset. It's like what banks do, right? When people sign up for credit, based on their credit profile, they're going to have a certain interest rate. Banks will use something like the Libor rate and then add on a specific amount based on the risk profile. So somebody with like really bad credit may have like an interest rate of like 12%, whereas somebody with excellent credit may be like at like 7 to 8%. It's still essentially the same thing, but depending on what you're trying to invest in, that's going to determine how much return that you really want to seek from that investment. Buffett and Munger spoke about this in numerous places, and he mentioned the same thing. So Buffett and Munger both use this business valuation approach. I'm sure they know everything about cost of capital and all the corporate finance stuff, but what they stick to is something that doesn't overcomplicate the whole process. If interest rates are really low, and are they really going to settle for something like 2 or 3%? That's not even worth investing. Despite how low interest rates are, there still has to be a minimum hurdle rate, a yardstick that you're trying to aim for. Okay, and they mentioned, one time that 10% was something they were talking about, and then they probably they just ended the talk there because it wasn't really that beneficial. But they're not expecting things less than 10% because they're also calculating taxes. So in the last quote here, Buffett says he wants 13% pre-tax. 13% pre-tax, of Sirius XM. When I was using it, I was using 7%. So that's a big difference. So it all comes down to what your investment hurdle is. If you have a portfolio of companies, or for example, if you're trying to buy another stock, and you calculate that your portfolio of stocks is returning about 10%. But this new opportunity, it's currently priced where it's probably going to return to you about 8%. That's a really easy decision to just say no and pass on because you want to buy things that are better than your current stuff, right? So when I update the cost of capital from like 7% to 8% using just this method where I just round up the value to 8%, you can see that there's a slight change. 7% has a fair value of $5.80, but 8% brings it to $5.24. And if I go back, then you can see that this is probably what discount rate I would use going forward when I also update my bear case, my regular case, and my aggressive case scenario. So once I set that, once I've got the free cash flow input that I want to use, then I've set the discount rates, and then now we get on to the growth rates. So what growth rate do you use? And this is a tricky one because there's the tricky thing about valuation in stocks is that it's so hard because there's just no one single easy catch-all answer. Especially when you come up on investment websites, they'll give you like an analyst growth rates or something, but I don't use just one. I know that if one is always going to be incorrect. So I take the wisdom of the crowd and I take an average, or a median of the values that I'm using. It brings up a story or a study that I read where there was a class where a professor had a jar of jelly beans and asked the students, each one, to guess how many was inside that jar. Okay. The results were shocking because not a single person got it right. And the actual closest answer was the one that was the average of all the students' answers. And so instead of just anchoring on one estimate or one price or one value, I'm going to take a broad range and I'm going to use it in my valuations because I know that I'm going to be wrong if I try to come up with a single value. So you can use historical growth rates, calculate year-over-year growth rates of either free cash flow, earnings, or whatnot. You can use the analyst estimates. Just go up on Yahoo Finance, Google, Reuters, Bloomberg, anywhere. They all have the estimates. So you can use those. I like to look up the latest. And since I have access to data, I sometimes look up like how much it's changed within like the past 3 months or 6 months, as well as their long-term projections. And so I get some short-term numbers, long-term numbers, and then I also use industry growth rates, because I know that if there's, for the majority of companies, they're going to ultimately go along with the industry. Rising tide lifts all boats, right? So if an industry goes from 5% all of a sudden to 10%, I know that most of the companies are going to go from 5 to 10. There are going to be outliers where it's just going to be way above the industry. And for that, you may have to factor it in. I mean, just off the top of my head, Amazon, because it's in the news all the time. And another important point with growth rates is that there is an upper limit. You know, a company is not sustainable forever to eternity unless there's a threshold. Amazon, despite how good it is, Tesla, with all the hype and the vision that it comes with it, it's not going to grow like 100%, 200% to infinity. It's just impossible, right? So that what that upper limit is, it's going to be ROE or return on investment capital if the ROE is negative. And I'll show you why. So if you look up all the industry, the return on equity, and then the actual fundamental growth, you will see that the company, the industry growth rate cannot exceed and will not exceed the return on equity. It's going to be, at best, it's going to be very close to the upper, like the really good industries. Like, for example, air transport, 37.8% growth, return on equity is 41.3%. You know, it's close to the top, but it's not going above. Because over the long run, you can't grow quicker than your return on equity, how much profit you can make. This chart shows all the individual industries. I didn't list the names because it was just getting so much text and so crowded. But the blue is the return on equity for each industry. Red is the actual fundamental growth number. And you'll see that there is no red bar that exceeds the blue bar. The only instance where this does happen is if the return on equity for the industry is negative. That's the only that's based on the data. That's the only scenario where there was actually some fundamental growth that exceeded return on equity. And even if it did, it was only barely. See, the very last one, tobacco, was the only outlier where the fundamental growth was still negative, minus 3.5%, but the industry ROE was minus 14.9. So it beat it by about, what is that, 11%? But for the other industries, this is the only list of industries where the growth exceeded ROE, and it was just barely. It's not like advertising was minus 1.1%, and then the growth rate was like 10%. Everything is still negative, and it only just barely. So if the industry ROE is negative, expect negative growth in the company. And you see it again in the visual chart. It's very close. You don't see much differentiation. But before I get on to the next part, let's talk about growth rate within the stocks. One of the ways I look up growth rate again is, okay, so I've gone through the different types of data. What I like to look for is I like to compare the 5-year and the 10-year depending on the history of the company. SiriusXM doesn't have a 10-year history, but what I do is I look up the 5-year multi-year performance. And this is a rolling period. It's not from, say, like 1, 2, 3, 4, 5. It's 1 1 to 3, 2 to 4, 3 to 5, and then 1 to 5, and then all these different combinations to get an idea of how a business has performed over several different periods. And by doing so, you can actually smooth out the data and really get a really good understanding of how the business has been ebbing and flowing. For SiriusXM, another reason why I chose free cash flow is I looked at the numbers here and I sort of had, you could tell based on this data that free cash flow is going to be the way to go. And then it's pretty much backed up when I look at the 5-year various multi-year performances of free cash flow. You know, you look at all these different periods, and the only down or the only single-digit growth period was in 13 to 2015, where it was 9.25. But then it was strongly followed up by 15.65 from 14 to 16. So over this 5-year period and all these different periods that I'm taking, the median value comes out to be 20.85%. So I'm using 10% here, which is going to be pretty undervaluing free cash flow based on how it's performed over the 5 years. And just based because I know that the company, just the business model, it's a very attractive business. It's why Warren Buffett has been buying SiriusXM. But 20.85 is a pretty good cash flow growth number. So I could do 20% here. So let me just see 20. So this would obviously be my upper range if I was to select the growth rate. So I'm selecting, and that comes out to $10. So based on this data, this scenario, I would say my really optimistic scenario, provided everything goes well, like the ads go up, they're able to get in more celebrities for the channels, they're able to expand, they're able to get into more cars, more people download their app, and etc. etc. I would say the best case scenario is at the moment going to be about $10. And which is about half, the current price is about half. So you get that 50% margin of safety. But let's check how valid that is. I've looked at free cash flow. I'm going to compare with, okay, earnings. Earnings growth is going to be 6.4, negative, low digits, very negative. You can see how volatile it is. And then it has a 4.55%. So this doesn't give me a lot of confidence in the number because just the fact of how volatile it's been. I'm looking for the numbers that are more stable. Then I'm going to compare with, because I mentioned that here, the upper limit is going to be the ROE or the ROIC if the ROE is negative. So return on equity for Sirius in the past 14 to 2016 has been negative. And it's the median over the past 5 years is 25.7%. But let me quickly do a double check. Okay, so provided the company is able to get things back on top in terms of profitability and just managing the business, I'm looking at 25.7%. The cash flow is definitely within this upper limit of 25.7. So this optimistic is quite possible. I'm going to go into key stats because I want to look up return on invested capital, because you see here, return on equity is really low. This is in percentage form, minus 94%. It's like really low. So that's not, obviously, I don't believe that SiriusXM is going to start going down the drain. Okay, return on invested capital is, on the other hand, consistently getting in the teens. And right now it's in the upper teens. So the free cash flow was 20 point something percent. The return on invested capital, right now, if I just use the latest data, it's 19.25%. Go back into valuation. Go back into valuation. Oops, update that. Okay, so instead of that cash flow 20.85, because the ROIC was about 19 point something, I don't think it's going to, so that obviously pretty much confirms that the free cash flow, this number is going to be really the upper. Okay, so don't expect, like in terms of probability, what chance does Sirius XM have of doing this? Not sure, but it's not going to be like a 50% probability. Okay, let's look on the downside. Let's say earnings growth was, let's say the company is going to go, they're going to lose subscribers. People are going to uninstall it from their cars. They're going to lose a lot of licenses from like Ford, Buick, and Toyota, Honda, and everything. And their cash flow and their earnings actually takes a huge hit. So if they, just using last year's numbers, if I say the growth rate is going to be, let's see, growth rate, they've statistically done about 4.55%. If I just keep it at that median, 4.5%, the valuation is going to be from $1.40 on the very, very bear case to $10. And again, a reason why people don't like this practice of taking ranges is because you have to force yourself into thinking about wider ranges, thinking about the bad and the optimistic solutions, and then being realistic with those numbers. So on the same thing, if I put like a very low probability of something, of everything, the stars aligning and Sirius XM hitting $10, then on the same thing on the downside, how realistic is Sirius XM going to perform to show $1.40, right? So you have to come with that. So if I go back to like a reasonable, realistic range of saying the growth rates, I'm not going to put up 20%. I don't think that's going to be the case. And because the revenue, I'm looking at these different numbers. The default number based on industry analyst estimates and everything is actually 9.88%. But the beauty of the discounted cash flow is with the inputs that you have what's called a reverse growth. Based on the current information at hand, and with my current DCF start value, growth rate, and discount rate, it's telling me the current fair value is pricing in a growth rate of 9.73%. If I did 9.73%, you'll notice that the fair value at the moment, okay, sorry, it was the opposite. The fair value, the current price is pricing in 9.74%. The market is pricing in 9.74% into the current price based on the current free cash flow and the discount rates. If I did change, like let's say I change my starting value to like 2 billion, then the market is then going to say, okay, really? Oh, wow. Sirius XM did 2 billion. Then based on the current price, it's really going to be 5.27%. So it brings about the question, do you believe, based on your current input, Sirius XM is going to be able to beat, match, or underperform 5.27%? So that's the question that you start off with to set realistic expectations. When I did the low end, it was just way too low. When I did the high end at $10, it was way high. But now I'm moving towards the middle. I'm looking at the reverse growth rate, looking at what the market is expecting based on the current rate. And it's telling me 9.7%. Okay, so 9%, yeah, okay, I think that would be realistic. I mean, if I want to be negative, I would probably be like 5%. Okay, 3.66%. And then if I want to be positive, I would probably add a couple of percentage points on top of 9. So I'll do like 12%. So remember this number, $3.66. I do 12%, it's going to be $6. So now I'm saying, okay, my ballpark estimate is going to be about $3.66 and $6 in the fair value range. So that's my starting point. And from there, I would then go into my qualitative analysis to really understand more about the company, their margins, management, things like that, and to determine whether it's really going to be towards like the 7% or the 6% or the 12%. And that's how you do a business valuation to set your expectations clear about what it's going to be. If I quickly do it for Walmart, I'm going to go into DCF, and I don't have time to go through all the other valuation methods. There's just not enough time in 1 hour to go through the whole theory and everything. But with Walmart, same thing. What free cash flow, or do I choose a cash flow based, or do I choose an earnings based? I'm going to go look up the data, cash flow data. I look at free cash flow, owner earnings, and I look at earnings. And then I think to myself, I ask myself, okay, which one has the company been operating on? A company is usually going to focus on either driving cash and profitability, or they're going to be driving growth and spending as much as they can. A company that does a mix of both, it's going to be a slow to medium, and they're usually mediocre businesses or really mature businesses. Companies cannot serve two masters. In the case of Walmart, they've always, because of where they are in their maturity cycle, they don't go to drive earnings. They're not going to please Wall Street about, hey, we went from 1% earnings rate to 3%. Wow, hey, give us a huge stock price boost. They don't do that. What they go for is they run the business extremely efficiently, and they go for cash flow management. And that's why, even if you could read their reports, they place a lot of emphasis on the way they manage working capital, free cash flow, maintenance capex. There's barely any companies that mention maintenance capex and growth capex, but Walmart does. So so that's why I like to use free cash flow with Walmart. So I'm going to change it to free cash flow. So I've selected my input. Okay, now discount rate. 9%, obviously too high. What do I want from a company like Walmart? I could go to the spreadsheet and then find out what the industry cost of capital is. But at the same time, if I look at my entire portfolio and say, okay, my portfolio is pretty made up of some mid to small caps, and they have a pretty high return rates right now. What is my desire to be, to put my money in Walmart? Do I want to sell? If I want to sell something, it better be a better idea, right? But because I know the realistic expectations of Walmart is not at 9%, it's liken it to an extremely excellent credit person. I'm going to set this one again to 7%, not even 8%, 7%. And the growth rate, free cash flow. Since I'm using free cash flow and not earnings, okay, what is my bear case? My bear case is Walmart, they're going to close stores. They're going to turn out like Sears. They're going to turn out like Macy's. Their e-commerce ventures are going to go bust. Their acquisitions of Jet.com, ShoeBuy, and all the little bolt-ons they're going to do is going to completely fail. And based on, they're just going to do nothing better than what they are doing right now. And if that's the case, if that's my bear case scenario, that's my narrative, what I'm going to say is this free cash flow growth, this is still too high. I don't believe it. Earnings growth is going to be 2.97 on the top line. And I'm going to say, okay, if the revenue is going to be that much and revenue as well is 2.84%, I don't think it's going to be able to grow more than 10%, even though ROE is 21.5%, and it's done a magnificent job of being consistent. So if Walmart was firing on all cylinders, maximizing every single channel and asset they have, then they could possibly grow at 21%. But because of the size, I'm going to say, no, they're going to have all these issues. I'm going to just stick with my current growth rate of 5.94%. And if that's the case, my fair value comes to $71. But I'm going to adjust this down because they're going to lose money from acquisitions and things like that. So let's see. If I average the last 3 years of information, I didn't do this. So excuse me if I'm going to get it wrong, 30, 40, I'm going to say it's like $12 billion. 12 or $13 billion actually. At 5.94%, the fair value is going to be $56. So there is no margin of safety. If I want to buy it, because I probably was incorrect by like plus or minus 10%, if I want a 25% margin of safety, then my buy price has to be at $42. So I have to wait until then. So that's my bear case scenario. What about the optimal scenario? The optimal scenario that I place very little percentage probability is that they're going to grow at 21%. I'm going to keep the average of the past 3 years, keep the discount rate. And I'm going to say the optimal growth based on this is going to be $164. But I'm going to place like, say, 3 to 5% probability that this is going to happen. It's just to see the broad range of ideas, get my mind focused, and get my mind off, stop anchoring from what I'm just currently seeing. So I go from like 40 something dollars to 164, and now I'm going to work my way in. So growth rate is not going to be realistic. Let's see. I'm going to go through the data again. I keep saying Amazon. Walmart has a long history, so I'm going to compare the 5-year data with the 10-year data. I look at the data and I see that free cash flow over the past 5 years, the median has been 10.31. Over the 10 years, it's been 12.07. So the 5-year has actually been lower than the 10-year. So it's actually slowed down. Let's look at return on equity. Return on equity is going to be very similar. So I'm just going to say they're still operating pretty much the same, but the free cash flow has slowed down a little bit. It's not negative. It's still plus, but it's not going to be increasing at the pace it was. Earnings and revenue growth, obviously, it has dropped compared to what it has done previously. So when I compare a more recent picture with a bigger picture, I see that the most recent picture is going to be a little bit more difficult than what it has done previously. So I'm not going to give Walmart the benefit of doubt that they're going to perform as usual like they have done over the past whatnot. So right now, optimal, I'm going to wind this down a little bit, comparing what I see with the cash flow data, the 5-year and the 10-year. I'm going to say, okay, if this right now, I don't know, 10.31%. My narrative of the story is it's still going to be a lot of investments, a lot of things that they have to do to catch up to Amazon. So let's say the cash flow 10 years ago, the cash flow was 12%. 5 years median is going to be, forgot that already, 10%. So I'm going to say in the next 3 to 5 years, it's going to be a little bit lower because they have to keep reinvesting. Based on this, my fair value comes out to be $65.49 with a 25% margin of safety, $49. And then I'm going to do plus and minus a little bit percentage to, this is going to be my conservative, or not my conservative, my regular scenario. And my bear case scenario, Walmart, I still don't think they're going to go plummet down to like a 5% range, especially with cash flow. So I'll do just sensitivity matrix. Actually, I should just use that. It would be easier. With a growth rate of 8%, the sensitivity matrix is going to show you that 8% at 7% is going to have the fair value of 65.49. If I do the bear case at 6% growth, it's going to be 56.36, and an aggressive case with 10% growth in free cash flow, which is what it's been doing over the past 5 years, it's going to be 75.89, and this gives a margin of safety of the current price of 6.76%. And so my margin now is from 56 to 75, and then you work, and then again, to decide to get a better idea of which range, which end it's closer to, you then work into the detail, the qualitative analysis. So I don't think I'll have time to go through Qualcomm, Apple, and Crown Crafts, but I did spend a pretty good amount of time on Sears and Walmart, so that should help you out. So we get to the big picture. So valuation, again, it's a biased art. All the inputs are based on your assumptions and what you believe the company is going to do. It's either going to go down, stay, or it's going to go up. Okay, fair value is never a standing target. It's a range, and it's constantly going to be moving. So if you can, and if you're disciplined, plug in numbers and update it 3 months, 6 months. Don't let it wait too long. Bigger companies don't have to be updated as quickly as opposed to smaller companies. And I get the point, because if you're trying to use a spreadsheet, it's going to take forever to try. Like if you hold 10 or 20 stocks and then doing it every 3 months, it's a lot of work. So with a DCF, selecting the cash flows is the difficult, and this is where you have to account for the risk. This is where you think through the scenarios, determine what the risk is in the company, and adjust your cash flows and starting points like that. Again, it all comes down to practice. I do this because I'm constantly practicing over and over again. On any given day, on my good days, I'll go through like 20 to 30 companies, thinking through just valuations, inputs, cash flows, and then just doing it over and over again. And that way I'm able to recognize patterns and come up with some internal metrics and yardsticks of what type of inputs I need to use. And don't overcomplicate it. The free cash flow, sometimes DCF valuation and valuation in general, it sounds just so simple. And some people do it in such a simplistic manner. And sometimes that's really the best. You don't fall for the fact that it has to be complicated. A lot of people on Wall Street, all those analysts and research analysts that put out reports and everything, they're paid to do that to make themselves look smart. Most of the time, all those inputs, they're all assumptions as well. How many analysts, how many people on the street have actually gotten their estimates correct? If they did, they'll all be millionaires, they'll all be billionaires, they'll be running their own hedge funds, etc. But their job is to constantly churn out these numbers, make companies look more complicated than they are, make themselves look smarter. So don't complicate it, don't fall for that trap. And again, number 5 is really important. I can't stress enough. There's a limit to how fast a company can grow. The upper limit is going to be ROE or ROIC, depends. I like to use CROIC, depending on the company as well, cash return on invested capital. But unless the company goes into starts leveraging, starts really diluting shareholders, the growth rate is the sustainable growth rate is going to be ROE. So what are you going to do? This brings me to, you can take everything I've taught you today. So I've gone through a lot of the content, a lot of the information. You can use trial and error, and you can waste time and money and then make all these calculations. And you're likely going to spend a good chunk of time copying and pasting and potentially making data mistakes. But what we do at Old School Value is we take a shortcut in the whole process so that instead of just burying your head in the sand, trying to get all the copying and pasting the data, we get you focused on thinking through the process, thinking through the whole picture, getting a big idea of how valuation works so that you can take a big holistic approach to valuation, take an objective approach, not an objective assumptions, but take an objective approach to valuation so that you know if where you stand in terms of stock price, when you should buy and sell. Okay, the whole point is to accelerate your progress as opposed to doing manually all this tedious work, and to prevent making common mistakes that comes with the territory. Okay, so these are the type of spreadsheets that I used to work on. Mine are much more complicated than this because I've literally had hundreds and hundreds of data points that I was manually filing and collating and calculating and whatnot. And by the time you finish one company, it'll take an hour or two. And the problem with that is you force yourself into a bias of sunk cost bias where you've spent so much time doing it, you feel like you're obligated to purchase the stock because you've just convinced yourself that, okay, this is going to be a fantastic company. And because if you try to do the same thing for all these different scenarios, hey, good luck. So that's why at Old School Value, we offer tools, we offer valuation analysis and deep fundamental tools. I didn't go into the whole 1 hour is just really too short to go into everything. So if I just give you a quick overview, the way our members work is you get your ideas from this first section. I've labeled it step 1, step 2 to help you go through the whole process to think about it. You get your ideas from the homepage. You get gradients, you get grading tools, you get visual charts, so that if you're looking for something like with quality and value, you get an idea quickly of whether it's something you want to look at. The stock database, we have about 6,000 stocks. We're working on cleaning it up even more to get the best database as possible. You can customize everything. So you can customize your reports. You can customize the Excel CSV files. And this will show you every single company that we have on file. On the screen is something that we recently launched. It's completely customizable. We have literally over 1,000 data points because we just try to provide so much information, give power to your fingertips, all based on growth, fundamental analysis, value metrics. So if I wanted to look up, say, like Piotrowski, oops. I'm going to expand all. You get to see, okay, each individual point of the Piotrowski score. You can select it, customize it, and then run the screen based on that, and then update whatever type of reports that you want to look at. So this is where you get ideas. From there, you quickly move on to getting stock summaries. So if I wanted to look up Walmart, then I'll be able to quickly get an idea. Okay, is this worth my time? Instead of going right into the valuations, I go, okay, here's a new company that I know about. Oh, okay, Walmart's a retail store. Okay, quick valuation. It's based on the default. You get all this data, quick valuations. We're constantly updating these charts. Okay, hey, and I'm like, oh, okay. Although Walmart is graded as a C, based on some stats, value score, oh, okay, it may not be the value that I'm seeking, but the quality and growth is pretty good. Okay, I'm going to look deeper into it. So then I would look into how every grade is scored. You get a detailed breakdown of how we calculate it. We keep things transparent. We're not going to disclose our exact algorithm, but we disclose all the numbers that we use so that you know what we're doing, and whether you agree with the numbers or not, that's always up to you, but we don't hide anything. Then the valuation, one of our goals is to actually make old school value into a productivity tool. So I spend a lot of time just being able to focusing and making better decisions, as opposed to just constantly trying to, update my spreadsheets and things like that. You get quality checks as you get deeper into the analysis. So Piotrowski, Altman Zeds, Benaish, other information. And then once you've have a pretty good idea about the company and that, okay, there's no red flags or anything, you can start digging into like the key stats, the historical data of like, okay, we've got color coding to help you visualize it and see where it's at. Walmart is currently trading on the earnings side close to the top. On the flip side, on the cash flow side, it's trading close to the bottom. So if you believe free cash flow as opposed to earnings, then you know that Walmart is going to be a pretty good buy. There's all these different other metrics and ratios that we go over. I especially love going over the cash conversion cycle, especially for retailers and other companies. Just really helps see the health of the business. And all these other value metrics that are pretty hard to find elsewhere. And once you've done that, let's say I wanted to compare Walmart with, like, say, Target, let's say Sears Holdings. I get a very easy, okay, Sears Holdings, they have pretty good, okay, wait, I'll show you what my must-haves are. Another company, let's say TJX, retail company. I can see visually side by side and then compare again whether Walmart is really the company that I want to be investing in. I obviously don't want to be in Sears Holding. They've got, it's just red everywhere. And then the final is when you really go into your fundamental analysis. So all the balance sheets, the income statements, we get all this fundamental data for you to really dig into and give you control, because it's all about your investment process and just being able to go from the top of the funnel of finding stocks all the way down to making an investment decisions that you can be confident in.